Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is June 16th edition of Market Outlook. Well, we certainly have been in a more interesting ride than the relentless drive upward, and we're going to get into it right now. Also, don't forget to sign up for this video newsletter. You get it free every week. And get this complete review of the markets. So today we're going to focus on looking at the spiders, NASDAQ, some of the market internals and bonds. And let's get right into it. The first thing to notice is you can see we've got this very interesting channel developing, which we tested right here and had that vicious rally right off of the 50-day moving average. And we still have this slingshot pattern. And of course, the market internals indicating that the Hindenburg pattern is still in place. So really, until we get a close above this key candlestick, which is quite a distance away, we're not out of the woods yet. Now, the thing that is most interesting is this level of compression. So a couple things have going on here. You had, that test of the 50-day. You have not really had any serious accumulation days in quite some time. So the market is still under pressure from a volume perspective in terms of institutional buyers coming back in. So the way I would look at this and the way I would play it is you have a scenario where you have this level of compression after this reversal and a bounce off here. So if we can get a close above, let's say we can move it up a little bit, really about 165.50 in the spiders, you would say that potentially you've got enough compression now in here to power this thing out to new highs, and it would be worth taking a shot in here. Don't forget to manage your risk appropriately, and this is the type of stuff that we talk about and manage in our various trading rooms. Mish's Market Minute Premium service will help you navigate through how to tactically handle these trades. Additionally, if we can get a close under the 50-day moving average and a new low close under this gap day here, let's take a zoom in on it here. You can see that this gap day here, we've held it each time. Any close below 161, the longer term trend line also would be violated, as well as the 50-day moving average. And that's why this is probably one of the more interesting setups, as all these points are converging with enough compression that the move is going to be substantial either way, depending on how it breaks. Okay, let's take another step back and see on the weekly charts what's happening here. As you can see, nothing really new has changed since the last update, because we touched the top of this fanning action, coincides with that huge reversal pattern, that slingshot pattern, and we also held the 65-week and the 50-day moving average. So things are really converging here, and you want to stay really frosty, right? On the weekly charts, we're neither overbought nor oversold. So things are still, fairly mixed. I'm going to get into some of the other details as well to maybe shed some light on which way this thing might play out. Before we leave here on the indices, I want to go over the Qs, because they are actually exhibiting a slightly more interesting and pronounced channel as well, and had an inside day. And as you know, we like inside days because trading off a compression is very, very rewarding. So you can see on Friday we had an inside day to the reversal day on Thursday, that big powered up day. So yes, we did have a down a down day, but still within the confines of the prior day. Now, the reason why I wanted to point out the cues here is look how pronounced this trend line is and this particular channel that it's trading in. So we definitely want to be cognizant of this particular channel here, particularly the upside. I'm going to give this a little extra weight. So you can see, you can definitely look at a breakout of this last 3-4 days of action and this trend line that you again would have enough power to potentially take out the highs. And again, any new closing high to me would be very significant. Not necessarily the wick, but a closing high, since we got that reversal pattern, the slingshot pattern here, right? If you're a candlestick chartist, it's a bearish engulfing pattern with good volume at a new all-time high. That's pretty damn significant. So again, the Hindenburg, the market internal type indicator, still in play, but if we can cross through this trend line here, and this is a good tell right here because it's so well pronounced and a little bit steeper than the S&P chart. So looking at these two together, you definitely want to see a breakout above this trend line and certainly above the last 3 days worth of price action as well. Okay, let's take a look at some of the market internals. Well, we are definitely on an intermediate term buy signal. You can see we definitely got oversold. Market internals now have turned positive. We moved above this minus 150 line, which is our demarcation for the McClellan oscillator. So on a more intermediate term basis, the bounce off the 50-day, the confirmation with the McClellan oscillator, which looks out over the next couple of weeks. Definitely, not that you can't get another test of these recent lows, but overall, this indicator is giving us a definite sign that things were oversold. We got the bounce, and it's still in play. We're certainly not overbought. Got plenty of room to move to the upside. Now, looking out shorter term, again, we got really oversold. That's why we got pretty bullish last week. And as you can see, we still really, in terms of advanced declines, the market internals are still a little bit weak on the shorter term. We haven't been able to cross our buy zone after being oversold. We like to see in the short term both volume, which, by the way, did get an indication, but the breadth is still in question. So I would say this is moderately positive, not strongly positive. This one is a little bit more favorable, the intermediate term. So odds are in our favor on the market breadth and internals. Now let's take a look at sentiment. You can see the VIX here on the daily chart, VXX. We're now trading above the 50-day moving average, and also for the first time you can see that the trend is starting to turn up, and we're trading over that 50-day moving average. So that's pretty interesting right here. That's really a first this year where we've actually sustained almost a week's worth of price action above the 50-day moving average, and you can see it's turning. So you can see a pickup in volatility usually is an early indication of a potential sell-off. So we're going to watch this carefully, because clearly a move over the recent highs would definitely indicate a continuation of this trend. Obviously, increased volatility generally is associated with downside action. But nonetheless, you also want to watch this for a move back under this 50-day moving average. But this is definitely more of a warning to the bulls, right? If you're looking strictly at the VIX indicator, you can see that sentiment is definitely turning decidedly negative here. And so that's really the first time this year that it's been sustained. In fact, for quite a while, you can see that the 50-day moving average of VIX has been down for quite some time. You did have that brief sell-off in December of 2012. We had a couple days, quickly reversed. But you can also see that the slope of this has been steadily down, but has been completely flattening out at extremely low levels. So that is definitely more of a warning sign. So you can see overall trend is still positive. On the charts that we looked at in the spiders and the Qs. However, sentiment definitely turning decisively negative, and market internals slightly positive to fairly positive. All right, now let's take one other look. Let's take a look at bonds, because bonds are the key to this market. Let's just focus on the most important elements. Right now, the biggest concern is, can the market sustain a rally with higher rates? You can see the TLTs here clearly tested the bottom of this channel here. So we also had a slingshot pattern here where we call it a glass bottom, because you can see we made certainly a new low it's almost the lowest bond prices have been in just about a year, and bounced off of that, including the trend line. See, look at this or channel line here. So you have a really well-defined channel that we're trading in. So this reversal pattern off of this channel could be that interesting indication that the bonds are going to, stage some sort of a rally off of here that would probably overall be good for the markets, but it's hard to tell how exactly they're reacting. I mean, obviously, slowing down economic conditions, lower bond prices have been lifting the stock market. But let's see what happens here. Right now, we really need to confirm this reversal indicator right here. And the way we're going to do that is pretty simple. If we could take out this trend line right here, I would say that the play for a bounce back up potentially to this declining 50-day moving average is in store. That doesn't mean that this bond bubble is not in the process of bursting, but certainly on a short-term technical basis, we can easily rally back up to the declining 50-day moving average, or our shorter one here, the exponential here, which I believe is a 70-day exponential moving average, which often works quite well in conjunction with the 50. So there you have it, a little reversal pattern at the bottom of the channel. Let's take heed of that. That might give a bit of a lift to the market. But we got Ben speaking, and that is really going to be determining what the next move of the market's going to be. Okay, that's it for now. Have a great weekend. Again, go to our website, sign up for this video newsletter, and be sure to always get it every week. Stay frosty. The market's definitely at an interesting point, and we got that Fed meeting, and that's going to determine quite a bit. Bye for now. See you next week.